At the time of this video, Keppel Pacific US REIT is offering a 13.64% dividend yield. Is it too good to be true? Let's dive into why it is giving such a high yield and whether it is sustainable going forward. Okay, so the REIT, short form as CORE, right? KORE, is a pure play US office REIT listed in Singapore. The portfolio comprises of 13 freehold office assets located in many cities such as Austin, Atlanta, Denver, and more. Okay, so a few of them are considered magnet cities or supernovas, which implies strong real estate prospects and the places where the population generally wants to migrate over to. Okay, and I've placed the US Real Estate Emerging Trends report down in the description below. You can check it out over there. Okay, before we move on to why it is able to give a above 13% distribution yield, right? Do help us to like our video and subscribe to the channel for you to enjoy more interesting stock ideas like this and learn how to invest for the better. And not to forget our favorite financial meme. Okay, back to the video. Why a 13% distribution yield? So in order to find out what conspire to allow for such a high yield, we must break down the number into two things. First one is the DPU, the other one is the share price, because the yield is DPU divided by share price, right? So for the former, which yield, we can see that the first half FY 2023 DPU is around 2.8 US cents. Okay, so if you were to analyze it, it is around 5.6 US cents. And when you compare it to the past few years, I can say that it's still not so bad because the decline from FY21, right, is because the prior years increase is too sharp. Okay, from 2020 to 2021 is too sharp already. Let's move on to the share price. So the share price is the determinant factor over here, right? Because since the DPU is relatively constant, okay? So the share price has already a 50% price decline. It shows that, REIT investors are spooked by the recent turmoil in the US markets with bank failures and high interest rates, as well as the work from home trend affecting just the US office REITs itself. However, right, personally, I feel that there's no reason for the REIT to fall below the COVID period. The share price has been dropping like, rocks until it's below the COVID period. So, it doesn't really make any sense because even though, there's a lot of factors going on, but it's not so bad as compared to the COVID period. And this brings us to the next section where we look into whether the DPU will be sustainable going forward. For this, we need to look at the portfolio's quality based on the corporate presentation. I've also leave the link down below in the description. Okay, to know whether the DPU is sustainable, we need to look to several factors. So firstly, okay, there is new listing demand expansion from the TAMI, the TAMI sectors, aka technology, advertising, media, and information. All right, as well as professional services, healthcare, and financial sectors. So there's new listing demand and expansion over there. Okay, next, the lease expiry in the next 2 years are still manageable at around 27 to 30%. Okay, and on the bright side, current rents are still below market rates, right? Around 6% below market rates. And there is positive rent reversion for FY 2022. Okay, so this is a sign that the US office downturn may be over. Okay, especially for this REIT itself lah. Okay, next, a good thing about core REIT, right, is the low tenant concentration risk because the top 10 tenants only contribute around 24% of the total cash return rental income, which is CRI in short. Okay, the weighted average lease expiry is also decent at 4+ years old. Okay, and the REITs portfolio can be said to be pretty resilient if you were to look into all these factors. And last but not least, right, contrary to the concerns that many people have over the US office REIT, you know, like the US tech layoffs, the work from home or trend and things like that. The REIT manager actually said in an interview that it can be a somewhat positive development US office REIT. He's talking about the tech layoffs. Why? This is because all these hiring freezes, right, and layoffs, right, are switching work flexibility to job security. Okay, that means a lot of people now are scared. They don't want to demand so much. I want to work from home and things like that. No. So they are going to secure their job instead. And this will be a push factor, okay, to get all these employees back to the office and in turn help core US REIT to get higher occupancy rates back to before COVID again. Anyway, to end off, if you want me to cover more REITs or US stocks or even Singapore blue chip stocks, do let me know in the comments below. Next up, check out this video for 5 defensive Singapore stocks with at least 4% dividend news. And I will see you next time. Thanks for watching and ciao.